and welcome to the Finwell Daily Brief for Monday, March 24th, 2025. This quick update will cover the key financial news you need to know. India has this really strong savings culture, households putting aside something like 30% of GDP. For a long time, that was mostly gold or maybe fixed deposits.
Right, the traditional assets.
Yeah, exactly. But what's interesting is how that's changing, especially with younger folks.
Yeah.
We're seeing a real surge in interest for things like mutual funds, the stock market, and even digital assets. It's a really fascinating shift, this evolution in how India saves and invests.
Absolutely, and that's precisely what we're going to unpack for you in this Finwell Daily Brief. Those crucial market movements and financial news that you should be aware of.
Let's jump right in then to how the markets performed yesterday, March 24th. The Nifty 50 closed at 23,658.35. A healthy jump of 1.32%. It wasn't just the big guys, though. The Nifty Midcap 150 ended at 19,418.30, up by 1.12%. And even the smaller caps joined the party. The Nifty Small Cap 250 climbed to 15,392.40, a gain of 0.98%. And of course, the Nifty Total Market Index settled at 12,111.35, rising by 1.24%. Pretty buoyant day all around, wouldn't you say?
Yes, indeed. The synchronized upward movement across the different market caps suggests a broad positive sentiment driving the market. But what's particularly interesting is what happened with the bond market.
Oh, hey, what happened there?
The yield on the 10-year government bond actually saw a decrease. It settled at 6.6249%.
So the decrease in the 10-year government bond yield generally signals strong demand for these bonds. Investors tend to see government bonds as a safe bet.
Especially when they think interest rates might fall in the future, or when they just feel like they need some lower risk investments.
I see.
And, looking at the bigger trend, India's 10-year bond yield actually had its biggest drop in 4 years, back in 2024.
Wow.
It fell by 42 basis points, which is quite significant.
Yeah.
And this was mainly due to the government's fiscal discipline. And importantly, India's inclusion in those major global bond indices.
Which really opened the doors for foreign investors.
Exactly. It brought in a lot of investment. So this continued downward pressure on the yields could suggest that the market anticipates a potential easing of domestic monetary policy, maybe sometime in 2025.
Really interesting. Okay, so let's talk about the Indian rupee now. It seems to be doing pretty well lately.
Yes, it is.
Appreciating by 1.2% over the past week, closing at 85.59 against the US dollar. That's its best weekly performance in 2 years. What's driving this kind of strength?
Well, there are a couple of key factors at play here. Firstly, we're seeing a surge in foreign capital flowing into the Indian markets. This high demand for the rupee naturally pushes up its value.
Makes sense.
Secondly, there's been an unwinding of short positions.
Now, what does that mean exactly?
Basically, some traders had bet that the rupee would weaken. And now they're closing those bets, which means they have to buy rupees. And that further strengthens the rupee.
So it's a sign of confidence from global investors.
Yes, it shows growing confidence in the Indian economy.
At least for now.
That's right.
But as we all know, the global financial scene can be a bit unpredictable. There's talk of potential U.S. tariffs being announced on April 2nd.
Right.
Could this be a problem even with the rupee doing so well?
It's certainly a point to consider.
Especially with it being the best performing Asian currency this month.
While a stronger rupee can make Indian exports more expensive for buyers using dollars, which could impact our competitiveness. These upcoming U.S. tariffs pose a more direct challenge. Even if they're targeted at specific sectors, they could create uncertainty and potentially reduce demand for certain Indian goods in the U.S.
So while the strong rupee is a good sign, our exporters might still face some headwinds.
Yes, depending on the details of those tariffs.
It's something to keep an eye on for sure.
Definitely.
Okay, let's shift gears to commodities. Gold prices seem to be holding steady, but we've seen a little rise in crude oil prices. What's happening there?
The stable gold prices could mean that the overall risk appetite is balanced right now. Neither extreme fear pushing investors towards safe havens, nor too much optimism leading them away from it.
Makes sense.
The slight increase in oil prices, though, is mainly due to the ongoing geopolitical tensions in the Middle East. Any escalation or even the anticipation of potential disruptions there creates worry about global oil supply, and that always pushes prices up. It's a classic case of global events influencing the market.
Right.
Which then affects everything from inflation to transportation costs.
Exactly. And speaking of things doing well, let's talk about India's IT sector. It just keeps performing strongly.
Yes, it does.
Strong earnings and high global demand. a real powerhouse for the Indian economy.
Without a doubt, India's IT sector has been incredibly resilient and a major contributor to our growth. The continued strong earnings show a healthy demand for their services globally. This sector is benefiting from the worldwide digital shift, and India, with its skilled workforce, is a key player in that.
It's great to see. And the strong IT sector also helps the rupee with the foreign exchange it brings in.
Yes, it does.
So zooming out and looking at the bigger picture here, what's the key message for our listeners today?
I'd say the overall feeling is one of cautious optimism.
Okay.
The stock market gains and the strong rupees, they definitely point to a level of confidence, especially from those international investors. But the upcoming U.S. Federal Reserve decision, it creates some uncertainty in the global outlook, and that can definitely impact emerging markets like India. It's also crucial to watch those key U.S. economic data releases, things like consumer sentiment and inflation figures. They can give us hints about what the Fed might do and how that might affect our markets.
And as you mentioned earlier, the dip in the 10-year bond yield, it suggests expectations of easier domestic monetary policies later on.
Exactly.
So it's a mix of good signs at home, along with some uncertainty from the global scene.
Precisely. And in this kind of situation, the best approach is to have a diversified investment portfolio.
Okay.
Spreading your investments across different sectors and asset classes can help cushion against any volatility, whether it comes from domestic or international factors.
That's a great takeaway. So for everyone listening today, the important thing is to be balanced. India's growth story is promising, but we need to remember the uncertainties out there. Staying informed and diversified is your best bet in navigating this ever-changing financial world. If you found this FinWell Daily Brief helpful and want to stay up to date on the latest financial news, be sure to subscribe to us for regular updates. You can also find us on LinkedIn. Connect with SOS FinWell there for deeper discussions and insights. And don't forget to subscribe here for more of these briefings. And on that note, we'll leave you with some wise words from Warren Buffett. Do not save what is left after spending, but spend what is left after saving.